We'll dive deep into both the basics and advanced techniques. Whether you're a beginner or an advanced trader, be sure to watch the entire video so you can understand every concept in detail. I'll also reveal 3 high-probability trading strategies using order blocks. By the end of this guide, you'll have a solid understanding of how to leverage order blocks for consistent profits. Overall, this video serves as a complete masterclass on trading with order blocks. So let's dive in. Here are the topics covered in this video. First, let's start by understanding what an order block is. An order block is a key area on the chart where significant amounts of capital have entered the market, typically by big banks or large institutions, often referred to as smart money. Since they trade with substantial capital, their actions usually cause noticeable price movements on the chart. So if you notice the price moving sharply from a specific area, like this one, it could indicate that smart money has taken a position. Large buy orders are needed to drive the price up this quickly. The initial area where these trades are executed is known as an order block. Order blocks can be of 2 types: bullish order blocks, which are caused by large buy orders, and bearish order blocks, which are caused by large sell orders. For this video, I'll color bullish order blocks as blue and bearish order blocks as purple. But of course you can use any color you want. Once an order block is identified, it can provide potential trade opportunities, as the price tends to retest and bounce after hitting that area. For example, if you bought at the order block here, it would have resulted in some nice profits. Now, you might be asking yourself, isn't this the same as support and resistance? While both order blocks and support resistance are considered key levels, they are not the same, as there are major differences between them. First difference is how they form. Order blocks are formed based on significant price movement on a chart. For example, if the price moves significantly from an area, you can draw an order block. In contrast, support and resistance levels require prior rejections to form. For example, if the price once rejected this level here, and another rejection happened here, then we can draw a support level. Second difference is how they are drawn on the chart. Order blocks are typically drawn as thick zones or areas, while support and resistance levels are usually drawn as lines. Even if they're drawn as zones, they're usually thin zones, not as thick as order blocks. Third difference is the number of retests. Order blocks are typically a one-time use, meaning if they are retraced once, they're done. You cannot use them multiple times. In contrast, support and resistance levels can be retraced multiple times. While order blocks and support resistance differ, they can be used together. For example, if an order block forms while the price is also at a resistance level, this is called a confluence. Finding this kind of setup is ideal, as the price has a higher chance of reacting to an area of confluence. Now, before we can trade using order blocks, we need to know how to correctly identify them. Remember, in our very first example, I mentioned that if the price moves significantly from a point, we could draw an order block. Well, it's not quite that simple. A significant price move doesn't automatically mean that an order block is present. There are specific rules that determine whether an order block is valid. So here are the 3 important rules for a valid order block. These are crucial, as you won't be able to trade the strategy if you don't get these down. Rule number 1. For a price to be classified as an order block, it must create some sort of gap afterward. This gap is what people refer to as inefficiency or imbalance. So, anytime you hear these terms, it simply means gap. Let's see an example so you can understand better. Here we have 2 similar price movements. Both moved upward significantly. However, notice the key difference. The one on the left has a gap between the first candle's upper wick and the third candle's lower wick, while the one on the right doesn't have it, as the wicks are intersecting with the candle's full body. This gap is what's called an inefficiency or imbalance. So, even though both setups show significant upward movement, only the left one counts as a valid order block because there's inefficiency. To draw the order block, take the first candle before the inefficiency and draw a rectangle over the full candle from the top wick to the bottom wick. Rule number 2. An order block needs to be unmitigated. Order blocks are generally a one-time use. If the price touches an order block, it's no longer considered valid, meaning it can't be tested or retraced. For example, let's say you spot a gap or inefficiency in the price, so you draw an order block. If you see the price, or even just a wick, touching that order block, it means the order block is no longer valid because it has now been tested. While there are strategies to reuse a tested order block, I'll cover that later in the video. But for now, just remember that an order block is generally a one-time use. Rule number 3. The most important rule is that an order block must lead to a break of structure, or a change of character, afterward. Now, For those of you who might not be familiar with these terms, I'll give a quick recap. But if you already know what they mean, feel free to skip ahead to the timestamp displayed on the screen. So basically, we know that markets have trends, uptrends and downtrends. Let's take an uptrend as an example. During an uptrend, the market doesn't just move straight up. Instead, it moves in a structured way, forming what's called higher highs and higher lows. They're called higher highs because each high is higher than the previous one, and higher lows because each low is also higher than the previous one. On the flip side, in a downtrend, the price forms lower highs and lower lows. These are called lower highs because each high is lower than the previous one, and lower lows because each low is also lower than the previous one. In a market structure like an uptrend, each time the price breaks the previous highs and creates higher highs, like this, it's referred to as a break of structure. Now, of course, markets don't stay in an uptrend forever. At some point, the trend will change. This shift happens when the previous lows are broken, leading to the formation of lower lows. Remember, before the break, we have higher lows. But once the price breaks those levels, they become lower lows. This break of the previous lows during an uptrend is called a change of character. Why? Because it shifts the character of the market from an uptrend structure to a downtrend structure, and the cycle repeats itself. During a downtrend, the price forms lower highs and lower lows. When the previous lows are broken, this is now referred to as a break of structure. In the future, if the price breaks the previous highs and forms higher highs during this downtrend, that's called a change of character, because the price shifts from a downtrend structure to an uptrend structure. So that was a quick overview of what a break of structure and change of character are. Now, how does all of this relate to order blocks? For an order block to be valid, it must lead to either a break of structure or a change of character afterward. Let's see an example. In this chart, we see a significant upwards move, coupled with a gap or inefficiency. So, there's a possible order block here. However, this doesn't mean we can immediately draw an order block, as we need to first see if the market forms either a break of structure or a change of character afterward. Right here, we notice that the price hasn't yet formed a break of structure, as it hasn't broken these previous highs, so we wait for the price to develop further. Now, once the price does break this high, forming a break of structure, that's when we can draw our order block on the first candle before the inefficiency. And again, we see the price move significantly upward, coupled with inefficiency, followed by a break of structure as the price forms higher highs. So, this makes it another valid order block that we can draw. Now, let's look at another example. In this chart, the price is forming higher highs and higher lows, and we have a possible order block here due to this inefficiency. However, since the price hasn't formed higher highs, we can't count this as a valid order block yet. After waiting some time, the price moves down and forms another possible order block, but this time it's a bearish one. This is shown by the significant downward movement, coupled with inefficiency on this red candle. Then, the price breaks the previous lows of the structure, forming lower lows. Since it made lower lows during this uptrend, it counts as a change of character, and the market structure has now shifted to a downtrend. So we'll focus on the latest order block that aligns with the current trend, which is this bearish order block. The previous bullish order block isn't valid because the price didn't form higher highs. However, this bearish one is valid because it resulted in a change of character. Here we see a significant upward movement, coupled with inefficiency, suggesting a possible order block. However, since the price hasn't formed a break of structure yet, this order block isn't valid at this point. After some time, we notice the price moves downward and then back up, forming another inefficiency, indicating another possible order block. This time, the price does form higher highs, but it's within a smaller structure. This makes it a valid order block within this smaller structure. However, if we look closely, we also see that the price made higher highs within the previous larger structure. This means the earlier possible order block is now a valid order block as well, since the price formed higher highs within that larger structure. So, when drawing order blocks, it really depends on which structure the order blocks are formed within. So, to recap, the 3 rules to identify a valid order block are: first, it must create a gap, also known as inefficiency or imbalance. Second, it must remain untested or unmitigated. Third, A break of structure or change of character must occur afterward. Identifying order blocks is a great skill, but the real excitement comes when you start using them in a trading strategy. Now, I'm about to reveal 3 order block strategies that can take your trading to the next level. Strategy number 1. Multi-timeframe confirmation. For this first strategy, start by finding an order block on a higher time frame. In this example, we're using the Bitcoin USD 4-hour chart. At a glance, we can see 2 significant price movements. The first one is moving upward here, and the second is moving downward here. Both of them also have inefficiencies. So, we have 2 possible order blocks, a bullish one and a bearish one. However, let's double-check if these 2 potential order blocks are actually valid. For this bullish one, the price did move upward with inefficiency, but it didn't form a clear break of structure. Plus, the price retested it afterward, so it's no longer unmitigated. For the bearish order block, the price clearly formed lower lows, creating a break of structure, plus it's unmitigated. So, based on our analysis, only this bearish order block is valid. Once you've identified the correct order block, the next step is to wait for the price to retrace back to that order block. The moment the price touches the order block, we now move on to the next step of the strategy, which is confirmation. We're trying to confirm whether the price will actually bounce off this order block. To do that, we switch to a lower time frame, like the 15-minute chart. On the 15-minute chart, we're looking for any signs of bearish momentum to prove that the price will reverse from this order block. You can use any type of confirmation tools, whether it be an indicator like the MACD, finding a bearish candlestick pattern, or spotting a change in market structure. Basically, anything that confirms that the price is likely reversing from this level. Now, my favorite confirmation tool is the bearish engulfing candlestick pattern, as it's simple yet effective for giving early signals. A bearish engulfing pattern occurs when a smaller bullish candle is immediately followed by a larger bearish candle that completely engulfs the previous one. This indicates a potential reversal from bullish to bearish. Once you spot it, you can open a sell position right after the pattern has formed. Then, place your stop loss slightly above the order block and set your take profit at 2x the size of your stop loss. As you can see, this strategy can lead to some solid profits. Here's a cheat sheet that you can use when trading on multiple time frames. If your high time frame is the weekly, use the 4-hour as your low time frame. If your high time frame is the daily, use the 1-hour as your low time frame. If your high time frame is the 4-hour, use the 15-minute as your low time frame. If your high time frame is the 1-hour, use the 5-minute as your low time frame. And that's all you need for strategy number 1. But before we continue, I want to talk about something that can help you trade these strategies more effectively. SimpleFX. SimpleFX is a free trading platform that offers all the stocks, crypto, commodities, and indices you could ever want to trade. From Bitcoin to the S&P 500 to even Nvidia stock, SimpleFX has it all. What's even better is that they come with a built-in trading view chart, which means you can analyze your trades and execute them all in one place. No need to switch between platforms. SimpleFX allows you to deposit using more than 70 different payment methods, making it incredibly easy to get your money onto the platform and start trading. And here's the best part. To thank my viewers, they're offering a $40 deposit bonus if you deposit at least $100. So when you put $100 on the platform, SimpleFX will give you an extra $40 to trade with. Give it a try. I think you'll love it. Strategy number 2. Inducement traps. An inducement trap is a specific setup that involves a minor key level forming near a major order block. Take this example. We have a major order block forming below and a minor key level forming above it due to multiple rejections. This minor key level is also referred to as an inducement. The strategy is called an inducement trap because in many cases, the price will break this minor key level only to retrace to the major order block before reversing back up. Traders who bought at this seemingly obvious key level, expecting a bounce, would often get stopped out instead. So, if you spot a setup where there's a minor key level sitting above a major order block, you can cue a buy order in the middle of that major order block. This way, your buy order only gets triggered if the price touches the order block, offering you a high reward trade. But if the price doesn't reach the order block, that's perfectly fine because no position was opened. While this may seem like a random and specific pattern, it's actually more common than you might think, and there are logical reasons to why this setup works. First, let's understand that large institutions want to enter the market at an ideal price. But due to their massive capital, they can't do so without moving the price. Unlike retail traders who can enter positions easily, smart money couldn't enter positions that easily, as their large orders would push the price up, causing their average entry price to be higher. So, in order to enter at a lower price, they use inducement levels. After entering the market and forming an order block, they push the price back down to that order block by trapping traders who bought at inducement levels expecting a bounce. This is effective because traders often place stop losses just below key levels, meaning just a little bit of selling pressure could trigger these stop losses, which in turn leads to more selling. This allows smart money, which entered at the previous order block, to re-enter at that price, driving the price back up. So, that's the basic logic behind why this pattern works. Now, let's look at a real example. In this chart, the price moves significantly upwards with an inefficiency, followed by a break of structure, making this a valid order block. After this upward movement, we identified an inducement zone as the price formed multiple rejections at this support level. Now, because we have a setup where there's a major order block below and a minor support level near it, this could be a potential inducement trap. This means the price could break the minor support level and retest the order block. So, we place a limit buy order in the middle of the order block and wait. As you can see, the price moved downward, broke the inducement level, and triggered our buy order at the order block. After the order is triggered, we place a stop loss just below the order block and set our take profit at 2 to 3 times the size of the stop loss. You could also target the inducement zone as your take profit. As you can see, this trade turned out to be profitable. Strategy number 3. Breaker blocks. In the very first part of the video, I mentioned that order blocks are typically a one-time use, but there's actually a way to take advantage of order blocks that have been broken. This strategy is called breaker blocks. What is a breaker block? A breaker block is a previously valid order block that has been broken. Once an order block is broken, the price may retrace back to that level, and it can act as a potential resistance level, where the price may reject this level. This gives us an opportunity to short at the breaker block. Keep in mind that breaker blocks are typically one-time use. After the price breaks and retests the level, their effectiveness is usually done. Let's break down this chart example. In this chart, we can see the price move significantly upward, paired with inefficiency. We also see the price made higher highs here, so we can draw an order block at this candle. But then, the price moved downward and actually broke the order block. This move also created a change of character as the price broke below the previous lows, indicating that the trend has shifted from bullish to bearish. Now, as the price retraces back toward the previous order block, it can now act as a potential resistance zone. This is a prime area to open a short position. Then, place your stop loss slightly above the breaker block and set your take profit at 2 times the size of the stop loss. And as you can see, the price rejected this order block, hit our target, and resulted in a nice profit. Now that you know these strategies,